The retail sector is in absolute freefall right now, and 2025 is shaping up to be the most brutal, blood-soaked year we've ever seen for some of the biggest names in the business. One by one, giant retailers that once dominated malls, city centers, and suburban shopping districts are falling like dominoes. And the financial carnage only keeps getting worse. Years of reckless expansion, crippling debt, skyrocketing inflation, and shifting consumer habits have pushed some of these companies right to the brink. And let's be honest, many won't survive. Retail insiders are sounding the alarm. More bankruptcies, more mass layoffs, more store closures are coming. And not just for struggling chains, but for household names you've known your entire life. We are witnessing the total annihilation of some of America's biggest and most beloved brands in real time. From department stores to discount chains, from fast fashion to legacy brands that have been around for over a century, no one is safe anymore. Moody's, S&P Global, and retail analysts from across the country are warning that 2025 will be an extinction-level event for some of these companies. These aren't just small dips in revenue. These are billion-dollar collapses unfolding in front of us. If you think your favorite store is untouchable, think again. Major names are already filing for bankruptcy, shuttering locations en masse, and scrambling for last-minute bailouts that may never come. Today we're breaking down 15 retailers that are collapsing right now. Businesses that are either already circling the drain or teetering on the edge of total financial ruin. If one of your favorite stores is on this list, this may be your last chance to shop there before it vanishes forever. Let's get into it. 15. Kohl's. Kohl's, a household name that traces its roots back to 1946, is facing one of the most brutal reckonings in the retail world right now. Once celebrated for successfully pivoting from a supermarket chain into a thriving department store during its first few decades, Kohl's is now grappling with increasingly dire financial realities that have intensified in 2025. Industry reports from Moody's Analytics highlight that Kohl's sustained a 17% drop in discretionary sales last quarter alone, following multiple months of consistent declines. Many analysts point to Kohl's razor-thin margins, which are leaving the retailer with little room to maneuver amid relentless inflationary pressures and stiff competition from e-commerce giants. Moreover, S&P Global data suggests that Kohl's debt obligations have grown by 13% compared to last year, while consumer spending in apparel and home goods has slowed to its lowest pace since the late 1970s. Executives tried to stay afloat by revamping store layouts, forging partnerships with fitness brands, and even investing in new private labels. Yet, according to insiders, these efforts haven't been enough to stave off the mounting threat of bankruptcy. With foot traffic slumping and no meaningful turnaround in sight, analysts are warning that 2025 could be the year Kohl's finally collapses for good. 14. David's Bridal. David's Bridal, once dubbed the Walmart of weddings, has reached a breaking point in 2025 that few in the bridal industry ever anticipated. After filing for bankruptcy protection twice in the last 5 years, the retailer has been in survival mode for an extended period, trimming payroll and closing underperforming stores in hopes of finding a buyer to rescue its iconic brand. Unfortunately, the bridal market has changed drastically. New competitors, particularly online platforms, are seizing significant market share, and consumers are tightening their budgets due to high inflation. Government data shows that the cost of wedding-related expenses has jumped 22% in the past 2 years, driving many brides and grooms to seek cheaper alternatives or even postpone ceremonies. David's Bridal tried to cater to this shift by launching more affordable dress lines and ramping up online offerings. But insiders report that back-end logistical headaches, such as supply chain disruptions, have kept shelves half-empty at many locations. The company's leadership warned stakeholders that if no major investor steps in soon, liquidation may be inevitable. With Chapter 11 proceedings hanging overhead and thousands of employees already laid off, David's Bridal's demise in 2025 looks more and more like the end of an era. 13 99-cents only stores. For decades, 99-cents only stores was a beacon of hope for budget-conscious shoppers who relied on bargain basement pricing for everything from groceries to household essentials. However, the punishing economic landscape of 2025 has caused the discount chain's already precarious finances to crumble. Data from Fitch Ratings indicates that 99-cents-only stores posted 3 consecutive quarters of negative cash flow, sending shockwaves through the retail sector. Once able to lure customers with ultra-low prices, the chain now struggles to maintain those discounts amid skyrocketing inflation, which has driven wholesale costs up 14% year-over-year according to the Bureau of Labor Statistics. Even more alarming, the brand faces intense pressure from national giants like Dollar Tree and Walmart, which leverage superior supply chain networks to keep prices comparatively lower. Many longtime shoppers lament that 99-cents-only shelves are increasingly stocked with products costing well above $1, undermining the very premise that made the chain famous. With consumer spending power eroding and the cost of labor climbing, experts warn that a large-scale restructuring or outright liquidation may be the only path forward. Despite attempts to roll out new product categories and store designs, the chain is teetering on the brink of bankruptcy. 12. Gymboree. Gymboree, a once popular name in children's apparel, is under enormous strain in 2025, leading many industry watchers to conclude that a third bankruptcy could be right around the corner. The brand was severely weakened by store closures and liquidations in the previous decade, but it seemed to gain a temporary reprieve after reorganizing operations and introducing digital-first marketing strategies. However, shifting consumer behavior and surging competition from online kids' clothing marketplaces have left Gymboree struggling for market share once again. A Morgan Stanley report revealed that Gymboree's foot traffic plunged by nearly 28% over the past year, with even loyal customers citing better deals and wider selections on e-commerce platforms. Additionally, supply chain issues and higher cotton prices have forced the company to raise prices on core items like t-shirts and jeans, driving cost-conscious families elsewhere. Insiders say that investor confidence is hitting rock bottom, with debt downgrades following each lackluster earnings report. Gymboree's management publicly acknowledges the severity of the situation. They've resorted to slashing marketing budgets and closing an additional 100 stores in an attempt to preserve cash. But experts doubt these measures will be enough to stave off another collapse, making Gymboree's longevity highly uncertain. 11. Starbucks. Even Starbucks, the coffee behemoth that once seemed unstoppable, hasn't been immune to the punishing tides of 2025's retail meltdown. Despite decades of explosive growth, the brand's latest financial statements show a troubling slip in domestic sales, as inflation-weary consumers scale back on non-essential spending. This shift may seem inconceivable given Starbucks' global ubiquity, but official figures from Bloomberg Intelligence confirm a near 9% decline in comparable store sales in the first half of 2025, its sharpest dip since the 2008 financial crisis. With labor costs soaring and supply chain disruptions hiking up coffee bean prices by an estimated 30%, Starbucks has found it difficult to maintain its historically high profit margins. Complicating matters further is the rise of rival chains and local specialty cafes offering cheaper beverages for budget-minded consumers. In response, Starbucks has closed hundreds of underperforming U.S. locations and expedited efforts to streamline operations. Workers have been voicing growing concerns about job security as mass layoffs have become a grim reality. Meanwhile, the brand's loyalty program has been criticized for losing value. Although Starbucks still boasts a massive global presence, analysts warn that if the economy continues to sputter, this coffee titan could face store shutdowns on a scale nobody predicted. 10. True Religion. True Religion, famed for its premium denim and celebrity endorsements, is facing its harshest year to date. Once a hot commodity in high-end fashion circles, the brand has been pummeled by the rapid shift toward comfortable, budget-friendly athleisure wear. Internal documents leaked by whistleblowers to a retail analysis firm reveal that True Religion's 2025 Q1 sales plunged by 24% compared to the same period a year ago, exacerbating mounting debts from previous bankruptcy proceedings. The brand's decline is partly attributed to younger consumers gravitating toward direct-to-consumer fashion startups, which often offer trendier products at lower prices. With raw material costs skyrocketing and department stores cutting orders, True Religion's once lucrative wholesale channels have dried up considerably. Even the brand's attempt to reinvent its image through influencer-driven social media campaigns has met with lukewarm results, as competition in the premium denim segment has reached an all-time high. Moody's now lists True Religion's credit rating at a level that signals an exceptionally high risk of default. Retail analysts predict that if this trajectory continues, True Religion will be forced into yet another bankruptcy filing, prompting a potential liquidation of any remaining standalone stores. In 2025, the future of True Religion looks grim indeed. 9. Belk. Belk, the regional department store chain with a heritage that stretches back well over a century, finds itself ensnared in the intensifying retail apocalypse of 2025. Once a staple in southern shopping malls, Belk's traditional business model is severely strained by seismic changes in consumer behavior and unrelenting economic headwinds. According to a recent report by Reuters, the company's same-store sales have dropped by 15% since the start of the year, reflecting a broader pattern of subdued discretionary spending. Belk had flirted with bankruptcy back in 2021, narrowly staving off collapse through an aggressive restructuring plan. But insiders now say those efforts merely delayed the inevitable. With the cost of goods sold rising sharply due to global supply chain turmoil, Belk's margins have eroded faster than anticipated. The chain also suffers from a lack of innovation. Many of its loyal customers are aging out of the market, while younger shoppers flock to fast fashion behemoths or online boutiques. In a desperate bid to stay afloat, Belk has begun shuttering more stores, shedding hundreds of positions and slashing its marketing budget. However, market observers warn that these moves may come too late, as Belk teeters perilously on the edge of another bankruptcy filing. 8. Clarks. Clarks, the iconic footwear brand founded in the early 19th century, is unraveling before our very eyes in 2025. Its heritage and global footprint provided a measure of resilience for decades, but even time-honored brands aren't immune to the extraordinary financial pressures of the current era. After a buyout deal in 2022, Clarks underwent extensive restructuring in Europe and North America, leading to a wave of store closures that eroded its once solid U.S. presence. Analysts from MarketLine note that the brand's sales in the States have fallen by 18% year over year, reflecting a combination of weaker consumer demand, mounting supply chain disruptions, and increased preference for e-commerce platforms offering steep discounts. Meanwhile, surging production costs, particularly leather and rubber, have further squeezed Clark's margins. Insiders reveal that morale within the company is at an all-time low, as thousands of employees have been laid off over the past 18 months. Attempts to modernize the product line and focus on digital marketing have been overshadowed by relentless debt obligations. Standard & Poor's recently downgraded Clark's credit rating to junk status, warning that the brand could be facing insolvency if the downturn persists. For a company that's been around for nearly 2 centuries, 2025 is shaping up to be a defining year of crisis. 7. H&M. H&M, once celebrated as one of the world's fastest-growing fast fashion retailers, is reeling from a relentless onslaught of financial and operational challenges in 2025. While the brand enjoyed global popularity for its trendy designs and budget-friendly collections, intense competition from online-only fashion houses has whittled away at H&M's market share. Additionally, shifting consumer sentiment towards sustainable and ethical fashion has put the company in the crosshairs of vocal critics who argue that fast fashion is environmentally damaging. According to the latest earnings call, H&M's revenue dipped 14% in Q2 of 2025, while production costs skyrocketed due to disruptions in major textile-producing nations. Over the past year, the retailer has shuttered more than 300 stores worldwide to cut costs, leaving thousands of workers jobless and fueling concerns about a broader retail collapse. Analysts at J.P. Morgan warn that if H&M's e-commerce push fails to offset losses from brick-and-mortar locations, the company may find itself on the verge of bankruptcy for the first time in its history. And with global inflation hampering consumer spending, it's increasingly difficult for H&M to recapture the loyalty of thrifty shoppers. If these downward pressures continue unimpeded, 2025 could mark the beginning of the end for the Swedish fashion giant. 6. Disney Retail. Disney Retail, encompassing the network of Disney-branded stores selling everything from plush toys to princess gowns, is staggering under the pressure of a volatile economy in 2025. Despite the enormous pop culture clout of the Disney brand, the retail arm has been hemorrhaging money for years, exacerbated by the accelerated shift to online shopping. Yahoo Finance reports that foot traffic in Disney's U.S. stores has declined by nearly 40% since 2022, a figure that has spelled disaster for locations already struggling with high rent and operational costs. Another contributing factor is the steep rise in production expenses. Industry observers say that raw materials for toys and apparel have jumped 27% since 2023, forcing Disney to hike prices and inadvertently drive away budget-conscious families. The entertainment titan also contends with its film slate underperforming at the box office, creating a ripple effect on merchandise sales. In response, executives have announced sweeping cutbacks, over 7,000 job losses across various segments, plus the shuttering of dozens of physical stores this year. While Disney remains a juggernaut in entertainment, retail insiders are whispering that its branded store chain might soon be relegated to a relic of a bygone era, unable to withstand the unrelenting headwinds of 2025. 5. Sears. Sears, the one-time titan of American retail that has been on life support for years, finds itself closer than ever to the brink in 2025. Having continuously closed stores since its initial bankruptcy filing in 2018, Sears was only able to stave off total liquidation through a series of desperate asset sales and mergers. However, these strategies have done little to reverse the brand's steady decline. By mid-2025, official documents show that Sears' total store count has plummeted to a mere fraction of its former footprint, with many abandoned properties being converted into e-commerce fulfillment centers by rival brands. Once the go-to department store for generations of Americans, Sears now suffers from a virtually non-existent customer base. After all, younger shoppers are more familiar with buying household essentials and apparel via e-commerce platforms than via a Sears catalog. Heightened inflation has also made it impossible for Sears to compete on price. Meanwhile, the Wall Street Journal reports that Sears' outstanding debts ballooned by another 12% this year, with no viable plan for repayment. Even longtime retail analysts who once believed Sears could reinvent itself are now saying that 2025 might be the year the iconic chain finally shutters for good. 4. Christopher & Banks. Christopher & Banks, a women's apparel retailer established in the mid-20th century, is facing a grim reckoning in 2025. Despite crawling out of bankruptcy a few years prior, the company has struggled mightily to regain its footing, losing ground to online competitors and facing wavering consumer confidence. Retail experts note that the brand's core demographic, middle-aged women seeking classic wardrobe staples, has become increasingly budget-conscious, spurring them to frequent discount retailers or turn to digital native brands with robust loyalty programs. Meanwhile, Christopher & Banks has had to contend with rising costs of labor, supply chain snags, and the persistent specter of inflation, all of which contributed to a 20% spike in operating expenses compared to 2024. The result? Shrinking margins and a recent spate of store closures that cut roughly 30% of its physical footprint. Rumors from industry insiders suggest the company is once again flirting with bankruptcy, as new capital infusions remain elusive. According to a Bloomberg report, private equity firms that once showed interest in acquiring Christopher & Banks have since retreated, citing lack of strategic clarity. Unless a dramatic turnaround plan emerges, employees and loyal shoppers alike fear the final bell is about to toll for this long-standing apparel brand. 3. Joann. Joann, the crafting and sewing retailer, finds itself in a precarious position in 2025 after a short-lived boom during the lockdown era. Back when people were confined to their homes, Joann enjoyed an explosion in sales, riding a wave of newly minted crafters and DIY enthusiasts. However, that surge proved to be a fleeting lifeline. Post-pandemic, store traffic dipped precipitously, and Joann's ballooning inventory costs, coupled with supply chain hang-ups, led to a profound financial strain. Data compiled by Moody's in late 2024 showed Joann's rising debt levels surpassing $400 million, sparking growing concerns among investors. Worse yet, the brand's core demographic, hobbyists and part-time crafters, has been disproportionately hit by inflation, forcing them to cut back on purchases like yarn, fabric, and art supplies. JOANN's leadership responded by shuttering underperforming stores, reducing employee hours, and slashing marketing expenses. However, these actions may have weakened customer loyalty and brand awareness at a crucial juncture. Insider leaks reveal that monthly revenue has sunk to a historic low, prompting warnings of an imminent bankruptcy filing if consumer spending doesn't pick up soon. For creative souls who cherished JOANN's aisles of possibilities, the store's unraveling feels like yet another devastating chapter in retail's ongoing crisis. 2. Morphe, the once buzzy cosmetics brand that rose to fame through high-profile influencer collaborations, stands on the edge of a dramatic collapse in 2025. After dominating social media platforms with color-packed palettes and viral makeup trends, Morphe found itself unable to pivot when consumer tastes shifted and controversies involving its brand partners exploded online. Sales began a steady decline back in 2023, and the subsequent years brought repeated lawsuits over unpaid rent at major shopping centers, as well as allegations of misleading marketing claims. Making matters worse, the cosmetics market has become fiercely competitive, with TikTok-fueled indie brands popping up seemingly overnight to steal Morphe's thunder. According to an analysis by Piper Sandler, Morphe's operating costs soared 35% in the last 2 years, due to increased logistics expenses and difficulty in securing raw materials for its products. Customer complaints about quality control and limited store availability have eroded brand loyalty, pushing Morphe further into the red. Parent company investors have publicly expressed doubts about a successful turnaround, citing a poorly executed omnichannel strategy. By the beginning of 2025, rumors of liquidation became rampant, as once loyal shoppers scrambled to find deep discounts on products that may soon vanish altogether. 1. Guess, synonymous with trendy denim and iconic advertising campaigns throughout the 1990s and early 2000s, has reached a critical juncture in 2025. For several years, the brand struggled to balance its legacy appeal with the demands of a new generation drawn to more sustainable, digitally savvy competitors. Despite a brief resurgence in 2022, Guess's North American division reported a jaw-dropping 22% year-over-year sales decline at the start of 2025, according to a quarterly earnings statement. Analysts attribute the slump to heightened supply chain woes, an inflation-driven dip in discretionary consumer spending, and a string of controversial marketing missteps. In fact, legal documents reveal that Guess is embroiled in multiple copyright disputes, including a high-profile clash with the elusive street artist Banksy, an incident that ignited a social media backlash and further damaged the retailer's reputation. Top executives, under pressure from shareholders, launched aggressive cost-cutting measures, axing hundreds of jobs and closing more than 80 brick-and-mortar locations this year alone. Yet these moves appear insufficient to combat the brand's ballooning debt obligations and dwindling consumer interest. Moody's latest rating slashes Guess's credit to near-default status, fueling speculation that 2025 might see the final unraveling of this once iconic name in the American fashion scene. Thank you for watching.